Thank you all for joining today. I'm excited to talk about investing and financial planning for Gen Z investors. And one reason I thought this would be fun is we do have some Gen Z folks in our office this summer, including Kaelen Perushek. Kaelen's wrapping up school at UCSB, but Kaelen, why don't you tell folks a little bit more about yourself before we dive
Yeah.
in?
Hi, I'm Kaelen. I am a Tortuga summer intern, and I'm going into my senior year at UCSB, where I study financial mathematics and statistics. So I'm kind of in that stage right now where I'm trying to seriously think about money, how to invest, how to build wealth. So I think this webinar will be really good for us to talk about those kind of topics. But if you have any questions during the webinar, please feel free to use the Q&A button, and we'll do our best to answer them at the end. And also there will be a recording of this webinar sent out afterwards too. Back to Jeff though. So how did you start at Tortuga Wealth?
Thank you. So I have a bit of a, I took a somewhat circuitous path, into wealth management, and I won't rehash the whole trajectory, but I essentially avoided finance for a while, got more and more interested, and eventually, after business school, decided to go into wealth management, especially in the early days with a focus on values-aligned investing. That's something we'll touch on later. But when I first came into the business, I thought that was, 100% what I was going to do, and that's the short of it. I've actually been at Tortuga for the better part of a decade, and previously worked for Morgan Stanley, as did the majority of my advisor colleagues here.
All right. Let's dive into some of the topics. So to start, a lot of people my age feel like investing is something that you deal with way later. So after like student loans, rent, all of life's other expenses. Why do you think that we should start now?
The truth is, getting started early does make a difference, and we would, recommend folks not dwell too much on the amount, but rather getting started early and through the power of compounding. And I imagine some of you have seen charts of just how small increments invested early on can turn into pretty large sums, in a decade or two.
Would you say even like $50 a month? Do you think that's still worth doing?
I think it's absolutely worth doing, and certainly if you had more to invest, that will have a greater impact. But it's really important to just get started and add more when you can, right? One nice part about starting and not looking for that perfect time is you'll naturally dollar cost average into the market, meaning whether the market's going up right now, you're buying at a slightly higher point, and then it goes down. If you keep investing, that tends to work out well in the long run.
That makes sense. Okay. So let's get into some myths. I've heard people say investing is basically just gambling. What do you think? True or false?
Gambling is really highly speculative, or 100%, versus when you're investing in the markets, there tends to be assets that are backing up what you're investing in. So there certainly is a level of risk, and that's going to vary depending on the particular type of investment. But as an example, if you're buying McDonald's stock, just to pick a stock, not recommending folks do that today. Today is not investment advice. Well, let's stick with McDonald's just to make it tangible. In buying it, you're not just betting on red. They actually have real estate, and they own, they have intellectual property, and they have, they're a dominant player in food, right? So, and I could give umpteen other examples, but there's some assets, and there's a business there as opposed to the gambling side. Hopefully
That makes
that
sense.
somewhat answers the question.
Yeah, no, it does. And what would you say for people say that they're going to wait until they have a 401k match before starting? Do you think that's smart?
I don't think that's the wisest move. 401k and other employer-sponsored, company-sponsored retirement plans are generally one of the best ways you can save for retirement. So and that's regardless of whether they offer the match, right? And I actually posted on this a while ago because I posted on LinkedIn because I hear someone say, no, my company doesn't match, so I'm not gonna, so I don't use the 401k. And I went on a rant on LinkedIn to say, please, like, forget the match or ignore the match because it's still one of the best ways you can save for retirement. Now, how much and how that relates to your um, other options, of course, depends on your individual circumstances. But in general, a great way to save on a tax advantaged basis for retirement. Match or no match, just to drive the point home.
We're gonna kind of talk about retirement now. I literally just turned 21, so retirement feels kind of a long ways away. But do you think that's something that people my age should really worry about right now?
I wouldn't say worry. Don't spend maybe too much energy thinking about it if you can avoid it. You're young and you're wrapping up school and hopefully doing more fun things than worrying about the markets constantly. To my earlier point, getting started early can certainly be advantageous, and we recommend folks do that. In general, right now, I wouldn't say you necessarily have to be super retirement focused, but focus on budgeting or finding ways to save a little more to start investing, and then as things evolve you can further prioritize in terms of saving for retirement and other goals.
Okay. So even without like a 401k match, you still recommend just kind of building that up.
Yeah, I
Both, yeah.
do, and I generally do. The ultimate answer will depend on the situation, but in general, folks should take advantage of what they have available to them. Not everyone has the 401k option. If you have it available, I recommend you look at it and see what you can afford to save. And I think, further on we'll dive into some other alternatives, and it's always good to consider, your opportunity cost. And if you didn't save there, that's usually my question to folks. If you didn't save it in your 401k, what would you do with it? Run it by me. Generally, the 401k is a good, pretty moderate option.
So I hear the term financial planning thrown around a lot. So how is that different from just managing investments?
Sure. The investments are really part of the broader financial planning process. Financial planning is about a complete picture of an individual or family's financial situation, goals, and current resources, and then prioritizing from there. And it's a dynamic process. But the investments would sit within that greater process. We would look at retirement planning, estate planning, right? Do you want to leave money to your heirs? Philanthropic goals. More broadly, what are your goals? And then working backwards from there. And given those goals, what vehicles and what investments, would make sense, would be suitable.
So it's kind of like you're not just growing your money, but also like protecting it too. And
Absolutely. And to your earlier question, the protection part might be a little less important right now when you're like, let's taking you as an example, Kaelen, when you're 20, single and 21, and I don't believe you have any kids. When the situation is more is straightforward, you can focus more on growth. And then folks tend to get a little more focused on asset preservation, right? Protecting their assets. As their assets grow and as they have a family, they have other folks to look out for. So again, yeah, financial planning is probably a bit simpler, for a Gen Z individual versus whose life, I don't know, life has gotten a little more complicated and they tend to be maybe in their 40s like me or beyond.
right. Okay, that makes sense. I guess our conversation a little bit more towards investments now. When it comes to like stocks, crypto, ETFs, like how do we know where to start?
And again, I don't want to provide something that could be construed as investment advice today. But we tend to like to keep things pretty simple for clients, and I think generally that's a best practice early on to start simple. That could mean having a low cost, broad market ETF that tracks the S&P 500 or other, broader indices. Um, that's that's a more moderate way to get started and build up your financial core, your foundation, and and then you can get more nuance from there. I guess the one caveat I would say, again, back to the like everything depends, is if folks are aware of their risks and they want to buy certain individual investments, there might be some interesting learning there. Like pick a stock, try to understand it, invest in it, see what happens, and use that to learn from. But that would not be the safest course. And then
Okay.
crypto, I've gotten that question a lot. And
Yeah, because I feel like my generation, like they either love it or they think it's a scam. So I kind of want to hear your
yeah,
thoughts on that.
exactly. I think the truth is somewhere in the middle, and it depends on how you're looking at investing in the asset class. It has become more mainstream, and now for certain clients that are more aggressive, we might look at crypto or a small allocation to crypto in different ways to do that. So now I don't think it's a scam per se, but I think the devil's in the details, and which cryptocurrency are we talking about, or are we talking about other blockchain related stocks? There's clearly something there. BlackRock and most of the larger institutions are now at a minimum looking at it, if not, have financial products now available. So it's gone somewhat mainstream. To wrap that up, it's still a lot more volatile than most things, so certainly not appropriate for everyone.
Okay. And what about meme stocks? Like, did your clients want to get in on those as well?
Yeah, the meme stocks were interesting, and those phenomenons where just, companies are shooting up and you have no idea why the stock is going up 200%. And I can understand the FOMO, and even I think some of us advisors get a little bit of FOMO at times. But something that can go up that fast can usually go down that fast. We would tend to steer clear of those investments, but again, depends on the situation and where we are in the process. When the company's just gone up 200% and you don't see any connection to the fundamentals, it's probably not the time to get into the stock, but certainly depends on the situation. There's a whole spectrum of risk. There's aggressive, and then there's like reckless, right? And reckless might include things like meme stocks or crypto, just kind of going in blindly into some of those high flyers, right? So I think if you go in, you have to go in very carefully with eyes wide open.
Makes sense. Good to know. Let's jump into values-based investing. So a lot of my friends want to invest in line with their values, so like sustainability, diversity. And can you do that without giving up returns?
There has been some academic debate on that, and in general, gone back and forth on the rules around, what can be factored in fiduciary duty to protect their investors. Should they consider ESG factors, right? Is that, to your question, would they be sacrificing return? And I think that the jury is still out to an extent, but I would say you don't necessarily give up returns, and it depends how you're looking at, within ESG, what factors are you considering? What values? How are you going to do that? There's different approaches, right? There's more proactive. I'm going to invest in companies, as an example, that have more women on their boards, better female representation, right, in the boardroom, or companies that are better managers of their resources, right? Use less water, et cetera. I think, those kinds of investments can do very well. And between sort of the green ESG investor and the evil investor, and both had good track records. So there's a lot of ways to make money, and I don't think you wouldn't necessarily give up return. And some would argue that you reduce risk by factoring in certain ESG criteria. So a lot of companies out there now do, and for a while have, consider different factors in terms of diversity, or environmental factors, or headline risk, and they do that not only to do good for the world but to make money. I don't get too bogged down in the name of a fund or a vehicle. It's more about, what's under the hood, what are they actually doing? And is that in line with what the client is trying to achieve?
Okay. And I've heard of greenwashing. So like, how do you make sure like that you're really investing in what you think you are?
Yeah, so that's
Yeah.
you do have to, maybe not dwell on the name of the company of the fund or the ETF if it's the,
Mhm.
what have you, if it has green in the title or it has equity in the title, et cetera. That's obviously less important than looking at the track record of that manager, their approach. Are they still is it really just S&P 500 and with some creative marketing, or do they do something more impactful? But I would just say that there's also, if you're looking to have an impact, there's what you can do in the public markets. You might want to look at what you can do within the private markets, within your fixed income allocation, et cetera.
Okay. So let's do some rapid fire Q&A.
Do it.
Quick answers only. So Roth IRA or 401k?
I would do both if you can. And if you can't, then you look at back to the opportunity cost, the particular situation. A Roth IRA does tend to be a good idea for folks who are starting to earn an income and most likely are in a lower tax bracket than they'll be, when they retire. Um, so that's advantage down the road. 401k is a tax advantage today, deductible. This is not tax advice either, but I take advantage of both if you can.
All right. And then invest or pay off student loans first.
Okay, that comes up a lot as well, the student loans. Again, it depends, but I'm gonna generally recommend folks build up their financial foundation, build up their assets before they rush to pay off their loans. So I think it's generally if you're chipping away at your debt, that tends to make sense.
Okay, what's the best starter investment?
Best starter investment.
Mhm.
We touched on that earlier. It depends, but all else equal, keep it simple, buy broad market, low cost investments. That tends to be a good way to start to build out your financial core, and then you can get a little more nuance from there.
Okay. And how often should you check your portfolio?
When we're in down markets, I recommend clients don't check at all. In fact, I routinely tell them to just go to the beach, and if they haven't logged in, it's usually this, in all seriousness. I'll have a client saying, "Hey, I'm having trouble logging in," and if it's a time like the onset of the tariffs or something else that's causing massive volatility, I'll usually tell them maybe now's not the perfect time to log in. That being said, I think quarterly is fine for most folks. I certainly wouldn't do it more than monthly. Our clients are generally hiring us to worry about the investments for them and allow them to focus on their family and their career and other priorities.
Oh, all right. And then can I invest if I'm freelancing or gig working?
You certainly can, and what might make sense if you don't have the 401k in that instance, but you might have a different type of retirement plan that makes sense, such as a SEP IRA, or it might be an individual 401k. So the fact that you're not at a large company doesn't mean you don't have your own set of opportunities available to you. If you had extra funds to allocate in a non-retirement account, that might also make sense. You've got some of the same opportunities, and then you have some different opportunities within the retirement space. And I see we're getting
All
some
right.
Q&A too. Should we start to
Yes.
maybe we want to
I was
start
gonna
to
say I was gonna transition to
close?
that. So I'm gonna ask you some questions from the
Oh, please
chat.
go for it.
Okay. So one is, do we need insurance and what kind of insurance would I need as a young investor?
Now that's a good one. What insurance you need depends on your situation. Either if you have kids on the way or if you're the sole breadwinner or the larger breadwinner, you would tend to want to look at life insurance, and then we can follow up with more detail offline. And what I'll mention one more actually that I didn't mention, and that's long-term disability. So that one is more about protecting your income, right? Which tends to be, that's one of our larger assets. Even if you haven't accumulated a lot of retirement or investment assets, your income is valuable. And something like long-term disability insurance, which your company may offer, but that's worth looking at, right? So we work with a number of folks in, healthcare, doctors, surgeons. Of course, they tend to recognize the importance of doing that. Like I have a client's a spine surgeon, right? Highly specialized. It makes sense to protect his hands, protect that income. Um, yeah, so that's another one that could come into play, and that's less dependent on, you wouldn't have to have a family per se for that to, make sense.
All right. Next question. So, how do I decide how much crypto or risky investment to buy without going broke?
Okay, I like that. Uh, that again, I can't really get into specific percentages, right, without knowing your broader financial situation. But I think if you're on the verge of going broke, you probably don't want to start. You probably don't want to start with such aggressive investments. Probably want to keep it a little more, we call it like vanilla, a little more boring in the early days before you start taking on much more volatile asset classes. Obviously, nothing can't answer that precisely without knowing more. Kaelen, you want to keep
Right.
firing them at me?
And then, okay. One of the questions is how should I juggle investing, paying off student loans, and rent? How can I plan or budget for that?
We touched on that a bit earlier. Yeah, it does kind of come down to budgeting. We don't necessarily get super granular on the budgeting front for clients unless they really, want that. But yeah, I think it's just you have to have some kind of budgeting process, and then as you think about how to, prioritize. But as I said earlier, I wouldn't rush to pay off the student loans to the detriment of everything else. So if, in other words, like don't pay off so much that you can't contribute to your retirement accounts. I would make sure you're doing some of those healthy financial moves, and chip away. You're trying to be balanced as you build up. What else?
All right.
Kaylin, I think we have a
You kind of
question.
talked about this a little bit earlier.
We have a question for
Wait,
you,
what? Oh,
which is
okay.
what are the most pressing concerns for Gen Zers and why?
I would say, honestly, I don't think I'll speak for myself, but I feel like also some of my peers have also expressed this. But we don't completely understand the big financial picture, and we don't have classes or anything to kind of slowly introduce ourselves. So I think that's like the biggest thing is sometimes we don't know what we don't know. So we don't know what to ask because we don't know where to start in the first place. So that's why I kind of think like webinars like these are really good to like kind of just get familiarized with certain terms so we know to like figure out, okay, like I heard that sounds important. Maybe I should go look that up and figure out, if I need to plan for that. So I think a lot of it is just about kind of not knowing what we're supposed to know and not knowing
Right,
how to kind of ask questions for it because we don't know it
right.
exists in the first place, if that makes sense.
Yeah. And you don't know what you don't know.
Exactly.
Um,
Yeah.
Interesting.
Okay, so one of the questions, we kind of touched upon this a little bit earlier, but how can you start researching which investment vehicle to start with? We talked about the good starter investment already, but
Well, there's certainly a lot of, resources out there now, in a growing amount of resources, and there's been um, good public sources for a while now. So I don't want to again promote, but if you're going on Google or Yahoo or any number of sources, you can take a um, closer look at Morningstar we use at work, or you could be old school, I guess, and go be like Warren Buffett and read the actual financial reports that come from um, individual stocks, right? Individual companies. Read their annual report and all their disclosures, and but in general, so that's pretty labor intensive, but there's a lot of good tools available online maybe to start that process. I like to read the Wall Street Journal or Barron's and, get kind of color. So that's not purely quant, but maybe more about the story of a company and what's happening, or what's happening at a certain manager. It's hard to say
Yeah.
exactly, like, again, like, is there one perfect way to start? Like anything, consult a number of sources, try to look at reputable sources. There's a lot of information out there and it's not all super high quality. So I'd pay attention to what's the credibility of the source, who are you listening to? Angela, Kevin, myself, we're certified financial planners. That tends to give maybe folks a little more comfort that we've gone through a multi-year process in the discipline of financial planning, and as opposed to some of the different so-called experts out there, but don't necessarily have as much background. Um, Again, don't want to be like too self-promotional, but I think you just need to be careful who and what you listen to.
All right. I think that wraps up the questions in the
Okay.
Q&A.
Yeah, well, I mean, we have I see one more that I don't know if I answered fully. Maybe I'll just try to answer it a little more fully. And
Yeah.
in terms of how can I tell if a quote green investment is actually legitimate? That is tough. If the company's been around for a while, then they've had to report their earnings and they've had to provide a lot of information on what's happening at the business. There should be some information out there. Of course, it's going to be, but it may be limited, especially if it's a newer company. So that's a little bit depending on the details as well. But there should be some public information out there. Then there's other vendors that, professionals like us use to maybe dive deeper and say, screen, if it was something very specific, I want to invest in the cleanest companies within, let's say, oil and gas, right? Maybe they're all, you know, the different approaches. Some folks want to, sometimes I go off a little on a tangent, but sometimes you look at a green fund and it's just all tech and it's all software and things that would like naturally be, lower in terms of fossil fuel emissions and, and pollution. Uh, Whereas you could also say, I want to invest in the cleanest companies in the dirtiest industries, right? That would be a different approach. Which oil and gas companies are, you know, improving their tech uh, such that it's a cleaner process, right? Um, so again, you might depends on the how deep you want to go, but there's different tools out there, and some advisors out there that have a focus on green investing. It is a bit of a research project.
All right. I think that wraps up the Q&A.
Great. Please look for the recording if you only got part of it, and feel free to let us know topics of interest in the future. And actually, I was talking to another a client the other day, and he said we got talking about more on the career side. So it might be interesting to look at, for Gen Z or my kids. I think my kids are Gen Alpha. How do you plan for careers in this very rapidly changing environment, right? With the advent of, we didn't talk about AI today, really. The advent of AI and how so many industries are going to be, massively disrupted. So I think that may be a topic, maybe something we visit a little bit further into the year. And with that, thank you guys so much and take care. Talk soon.